We're back in the saddle again. This is the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. And back with me today is Frank Boutelet, an emeritus partner at Witham and my co-presenter for the Society's Law and Ethics webinar. Welcome back, Frank. And
Glad
Frank,
to be here. Yeah.
Guess what? You are a winner at the Olympics, at the Accounting Olympics. Congratulations.
Oh, I'm so happy. Thank you. Thank you.
Okay. Wow.
Wow.
Yours looks a little nicer than mine.
No. So let's continue.
Okay. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA, CLA, or Witham. So Frank, last episode we introduced the technical questions and answers that are put out by the ASCPA. We talked about one particular section which pretty much covered some ethics stuff, right? Mm-hmm. And I think that you had here, you can see here, it's very hard, we can't show you on screen, but the table of contents is broken up by all different sections. So you don't have to just go search and search and search, and you can really drill down in. It's great. I mean, reach out to one of us. We both have a copy of this and we'll be happy to share it. So. Sure. What do you have, sections you want to cover today?
Well, I hope they noticed that we're wearing the same exact outfit as we did last time.
No,
our hair is combed exactly the same. This is awesome. Okay, so this time we're talking about cash balances and cash flow statements. So the question is, should the existence of cash on deposit with banks in excess of FDIC insured limits be disclosed in the financial statements? That's always a big question because they have, say the FDIC is $250,000 and they have $4 million in cash. Do you disclose that? Is that a credit risk? And the answer is the existence of uninsured cash balance should be disclosed if the uninsured balances represent a significant concentration of credit risk, which I would say on a $4 million balance, you would have a credit risk. So you should be disclosing it. So as a result, the bank statement balances in excess of FDIC insurance represent a credit risk. So they say that a concentration of credit risk exists if an entity has exposure with an individual counterparty groups. So what they say is, and the example for the disclosure, which I thought was really good because we have this all the time. The company maintains cash in amounts that primarily with banks located in Alabama. This happened, not my clients in Alabama, but in Alabama. That's the example. The total cash balances are insured by the FDIC up to $100,000 per the bank. The company has cash balances on deposit at 2 Alabama banks that exceed the balance insured by the FDIC in the amount of $1,100,000. So they are saying here you disclose the amount that it exceeds by. I've seen a lot of finance statements say it just exceeds it, and they don't tell you what the amount is.
Well, I like to just say that it exceeds insured limits. I don't even say FDIC, but go ahead.
Insured limits. So it says $1.1 million. Now the question is the $1.1 million on the balance sheet date or the date of when you're issuing the financial statements?
Here are the two problems I have with this in particular. First, I like to be general and just say it exceeds insured limits. Okay, but that's my own editorial comment. Mm-hmm. Is it the balance sheet date?
Yes.
Or does that really matter? Because, I mean, I'm working on financial statements right now that are 12/31. Who cares what the balance was then? What's it now?
Right.
Then, if it is the balance sheet date, well, my balance sheet may only say $100,000, and they have checks that are outstanding. Mm-hmm. Does that matter? And so now somebody's going to open up and say, they have $1 million, but according to the balance sheet, they only have $100,000. Who's hiding this money? It's going to raise so many questions.
It does. And one of our technical review people had seen this and said, you have to put the amount in there. Our firm never put the amount before. Yeah. So we're kind of back and forth on that.
Okay.
So the next one. Presentation of reimbursed payroll expenses. So when one company of a control group, in addition to its own operations, acts as paymaster for the entire group. Mm-hmm. The company records the entire payroll of all the members in the group on its balance sheet, that's general ledger, to facilitate the reconciliation of the payroll taxes. Each member of the group reimburses the paymaster for its share of payroll taxes. Should the reimbursement be classified as other income in the separate income statement of the paymaster? So this is where the common paymaster gets reimbursed, and I've seen where the company puts other income
Really?
for all of that reimbursement? And the answer is no. The reimbursement should be allocated again, and there is a reduction of payroll. So basically, they were putting in $4 million of payroll when the entity on its own only had $1 million, and the other entities were $3 million, and then they had $3 million of
I can't imagine somebody doing it. They have. It's a common paymaster. It's a holding company. Maybe has no income. Even it's just a holding company. And they have 100,000 income. I like the 100,000.
Yes.
They have 100,000 income, $4 million of payroll. They have a $4.9 million operating loss.
I know.
And other income of.
Well, and these questions, by the way, come from people asking this, firms asking this. So I know while it seems kind of like weird, someone asked that. Let's move on to cash flows. So is it necessary to provide a cash flow statement for both current and prior periods if comparative income statements are presented, but only a current balance sheet? So this is where you have the current balance sheet for 2022, and you have a 21 and 22 income statement. And the answer is, a business entity or nonprofit entity that provides a set of financial statements that reports both financial position and results of operations shall provide a statement of cash flows for each period in which the results of operations are presented. Meaning if you have two P&Ls, you put two cash flow statements, even though you only have one balance sheet.
And two statement of changes in equity.
Changes in equity, exactly.
Right.
So it always, you follow the income statement. The next question here, when only a statement of financial position is presented, that's it, just the balance sheet or statement of financial position, is it necessary that the auditor's opinion be qualified, right? Because I'm not including the statement of cash flows. And the answer is no, because, again, statement of cash flows is only required when you have an income statement.
Okay.
So therefore, when a financial statement of position is not accompanied by a statement of operations, there is no need to present the statement of cash flows, and no comment on the absence of the statement is necessary.
And so that's an interesting glitch, because what you're saying is you're only presenting on the balance sheet.
Right.
It's not like you're omitting something in particular. Whereas I looked at a tax basis financial statement, and they said that they omitted the statement of cash flows. Everything else was presented, and I said, well, that's not required because statement of cash flows is not.
And when you go to the next question, Brad, so you jumped ahead, but you knew you were jumping ahead because you're saying we're running out of time. When an entity prepares its financial statements in accordance with the special purpose framework, is a statement of cash flows required? And the answer is no, it's not required.
How about statement changes in equity?
Statement changes in equity, yeah. If you have
It is required.
It is.
Yeah.
It is.
So
they
put in the statement of cash flows, but another one, but they didn't say that they omitted the statement of changes in equity, which is easy. You usually put it on the bottom of the income statement.
Right.
Okay. Go ahead.
So let's go on to the next question. Let's see. Where are we?
Overdraft.
Oh, yeah, here it is. I missed it. So this is another good one, right? A company has accounts at 3 separate banks. One bank account is in an overdraft position at the end of the year. Thus, it is shown as a liability. A lot of times we don't see it as a liability, right? It's always netted with the cash. It should be pulled out of cash if it's a separate bank. Okay. Does the company show cash and cash equivalents on the statement of cash flows only the 2 accounts with the positive balances, or does it show all 3 accounts netted? And the answer was the company will show the activity from the 2 bank accounts with the positive cash flows, positive cash balances as cash and cash equivalents on the statement of cash flows. The net change in overdrafts during the period is financing activity in the cash flow statement. So again, it's part of finance. So it's a liability, and it shows as financing.
Does it matter
activity.
if your general ledger is negative or if the bank account is negative? I've never really seen a bank. I've heard of it, but you really usually don't see it. But there's a distinction between the two. I've seen that, because then it's a loan. If the bank is, if it's negative, then the bank is actually loaning you money. If you're floating, if you're playing the float,
well, but then you've recorded payments, so therefore you have payables that are now 0, and you have negative cash. So really, it should go against.
Definitely should go back to a liability.
Go back liability.
I've seen a lot of people show it as batting back accounts payable.
Yep.
I have seen bank overdraft too, though, or cash overdraft. One of the two. Go ahead.
Here's the next one. This is a good one too. So non-cash investing and financing transactions are to be disclosed in related narrative form or summarized in a schedule. An example of the transaction of this type would be an acquisition of equipment and a transaction in which the enterprise borrows money from the bank, for the purchase of equipment, and then the financial institution remits the money directly to the vendor. So I'm borrowing money from you, bank. You send it to the dealership where I bought the car. So therefore, the outflow of finance is a financing activity or investing activity. That's the question. Reply: the payments on the aforementioned notes would be recorded as a financing because it's a loan. So I wouldn't show the equipment on the cash flow statement. Right? Doesn't get shown there because it's a non-cash transaction.
Right.
So I'd be showing it as a non-cash transaction, and all the payments would be just going against financing activity.
All the payments that are made.
All the payments that are made, right.
I'll tell you a quick one. I had a leasing arrangement where my client bought the equipment and then sold it to the bank.
Okay.
I showed it as gross because they actually paid for the equipment and then got money.
Two separate transactions.
The reader's like, no, it's non-cash. I'm like, okay, it's okay.
And then the last one, which is another little strange situation, the buyer contracts to purchase real estate. The lender gives the buyer a check made payable to the buyer. The buyer then endorses the check over to the seller, just signs it over. How should this financing transaction be presented on the buyer's statement of cash flows? And the answer is it's two separate transactions. So it should be treated as a cash receipt by the buyer, since the buyer was named on the check. The amount of the check should be reported in the statement of cash flows, even though the buyer did not convert the check to currency or deposit in his bank account. The cash receipt belongs to the payee on the check. The buyer should present the check as proceeds from borrowings on the cash flow statement, as an inflow of financing transactions, and a purchase of real estate as an outflow in investing activity.
Because they actually took receipt.
That's right.
May not have been cash, put it in the bank, but they actually took receipt.
Even though they didn't get the cash because they endorsed it over.
Here's a quick one for you.
Yeah.
You have additions to fixed assets, but they're sitting in accounts payable.
Okay.
You haven't paid for them yet.
Yes.
So you have a non-cash addition. Yeah. So it usually it's not picked up unless it's significant. If they're doing construction, then I do something about it. You know where I think this is going to be a problem in the future? And I don't know this stuff. We'll have to get Sean Stein-Smith. You know where I think this is going to be a problem in the future? With all this Bitcoin stuff.
Yeah.
How it's going to be very difficult to keep track of. I think that we're at the point where we can't teach this course anymore and we need Sean Stein-Smith to teach this.
I'm all for that.
All right, Sean, get
I'm
in here.
keeping my medal.
All right, in closing, here's some upcoming accounting and auditing events. On August 30th, there's a 4-hour webinar, Current Issues in Accounting and Auditing, an Annual Update. On September 16th, there's a 4-hour webinar, Balance Sheet Management, the Least Understood Risk. And on September 19th, Renee Rampula is presenting a full-day Small Business A&A Update webinar. Get info on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting Audit Standards Interest Group. Sign up for free at njcpa.org/groups. Frank, gold medal winner. I think mine's bronze. Congratulations.
Mine's chocolate.
And thank you for pulling this information together.
Glad to be here and help you, Brad.
Thank you for watching or listening. Not only these, but these arms.